Hey guys, it's Brad with Review Properties. Thanks for checking out our video. We get asked this question from time to time because it is, in some cases, we throw this scenario out where it would work in a situation where seller's selling your house. It doesn't apply to all situations, so we don't recommend this for every situation, but sometimes it does work, and we've done some deals like this one before, and it worked out great for everybody. So again, I'm Brad with Review Properties. We're a house buying company out of North Metro Atlanta. I wanted to talk about today, how does seller financing work, or owner financing is what it's called. Seller carryback, those are some of the terms. Basically what it means is that the seller is the bank. Be the bank, right? Okay? So basically what happens is, here's the representation. So if you sell your house today, you get money today. You get a finite amount of money. Let's say it's $100,000, and you put it in the bank. Nowadays in the bank, your money's earning what, like maybe 0.5% of interest at best, like probably, if that, probably not. And you know, you could put it in investments, but if you just stick it in the bank, it's not really earning much money, right? So a lot of times with inflation, which on average inflation is 3%, over time, you're actually losing money by selling the house and taking the cash today. It's called the time value of money. But the house, over time, equals extra money, extra cash. Okay, so this is how it works. So you want to sell your house, and let's say your house is paid for. You don't have a mortgage on it, right? You own it free and clear. And if you do, congratulations, that's awesome. Only about 30% of Americans actually own their house free and clear. So if you wanted to sell it, you could sell it today and get some money, or you could sell it and earn additional money for that same house over time. And how that works is basically you would sell the house, you're the seller here, okay? Let's say I'm the buyer. You're going to give me the house. The title of the house is going to transfer from the seller to the buyer. So on title to the property, the person who pays the property taxes, who has the deed in their name, is going to become the buyer. You, the seller, are going to deed the property to the buyer. But in return for that, instead of the buyer giving you a big chunk of cash today, right here, the buyer is going to give you what's called a security deed. Now this is applicable to Georgia, okay? Some states are deed of trust states, mortgage states, it just depends. But in Georgia, this is how it works. You get a security deed and you get a promissory note. There's two documents, okay? The promissory note is a really long, drawn-out document that explains the terms of the deal. It explains the terms of the financing, right? That explains the interest rate, the terms, prepayment penalties, no prepayment penalties, when the loan has to be paid in full, when the payments are to be made, where the payments are to be made, what happens in the event of a foreclosure or in the event of a default. All of that information is spelled out in a promissory note. When we do these transactions, my real estate attorney drafts these documents. He drafts the promissory note for me. It's all done by an attorney, and all of this stuff goes and gets filed at the courthouse. Goes down to the deed records, and you file the security deed. You're going to file the deed transfer, right? You're also going to file a security deed. What the security deed does is it gives you, the seller, the house as collateral. So you basically get a security deed is basically a lien on the house. And in most cases, you're going to have first lien position, which means if the house defaults, you're the first person to get paid. Now, minus the government, they always get their taxes. They're technically always first, but you get first lien position, which means that if the house has to be sold at an auction, let's say, then you get paid off first. Whatever money you're owed, you're the first person to get paid, and if anybody else has a lien position after you, they get paid with whatever's left after you get paid. Okay, so you get a security deed at the courthouse, which means you can foreclose on that house if the buyer defaults and stops making payments to you. Just like if you've ever had a mortgage, this literally is exactly the same way the mortgage company does it. You give the mortgage company a security deed. You're pledging the house as collateral in order to pay them over time. And what you're going to do is the buyer is going to pay the seller monthly principal and interest payments. Now, in some cases, you can do interest only. I'll do another video explaining all the different scenarios on how that could work. But typically, you're going to pay principal and interest payments. So you're going to get principal payments, which pays down the amount that you owe, the principal balance, and then you get interest on top of that. So, and if you've ever had a mortgage, you understand that at the beginning of the loan, if you do an amortized loan, a lot of the interest is front-loaded at the beginning. So you're paying more of your monthly payment is paying interest than it is paying on principal. And then as you progress through time, the interest reduces and the principal gets bigger, and you pay down more on the principal. Once you get on that back half of the loan, you're paying a lot more down on the loan. So I want to give some examples here of how this might work. So let's say you sold a house today for $100,000. I'm just making this simple. But let's say you get $100,000 today, right? Well, if you sold that house on seller financing, you could maybe get a down payment today. Let's just make it simple of 10%. So the buyer gives you 10% down. So 10% of $100,000 is $10,000 down. So they're going to give you $10,000 cash money today in your hand when you sell it, and then you are going to carry back a note for $90,000. Okay. So I'm going to pop in here and refresh my computer screen there. So basically what that means, and then let's do an interest rate of 4%. Then today the interest rates are hovering around 4-ish% for a 30-year fixed rate mortgage. So on a 30-year fixed rate amortized mortgage, the monthly principal and interest payment made to you, the seller, would be $429.67. That's a $90,000 note at 4% interest over 30 years, 360 months. Okay, so you get $429 a month, and for the first month, $300 of that $429 is interest, and the remaining $129 is principal. Now again, over time, the interest amount reduces a little bit, and the principal amount goes up as they offset each other. So let's say it's $100,000. If you did that today, that's today. Now, if you did this over time at 4%, over 30 years, the buyer would actually pay you a total of $154,682.56 for that property. So you can actually get a total of $64,000 just in interest on that amount. So you could earn way more money over time for that same house over time, right? So, and then also what's another benefit of that? There's some tax benefits to this as well. You should check with your CPA and ask them about that. But if let's say this is an income property, typically if it's your personal residence, a lot of that is exempt up to a certain amount. But again, check with your CPA about that. But let's say this property you're selling is an income property. If you sell it today and you get a big chunk of cash, unless you do a 1031 exchange, like kind exchange, it's section 1031 in the tax book, you're going to have to recapture all that depreciation that you've claimed over the years, and you're going to have to pay long-term capital gains taxes on that $100,000. But if you carry back a note of $90,000, you offset that amount. So you're basically only paying capital gains taxes on, let's say, $10,000 today, and then you're carrying back over time. You're going to pay income taxes on the interest that you earn, but that's a much smaller amount, so you're spreading those taxes out over time. Now again, check with your CPA on how that works. I'm not a CPA. I don't claim to be a CPA. I use a CPA, and I love my CPA because that means I don't have to deal with all that. My CPA is an expert in taxes and make sure that I do them right. So check with your CPA about that. But this is how seller financing works. You can sell a house and you can actually earn money for that house over time and earn more money over time than you can earn today on the house. And your protection in that is the security deed and the promissory note in case for some, I really hope the buyer never defaults on you, but if that happens, you have security in which you can foreclose on the house, or in Georgia, there's a process called a deed in lieu of foreclosure. And basically what that means is, and you can spell that out in the promissory note, you can do a deed in lieu, which means the buyer will basically just deed the house back to you in lieu of going through a foreclosure. So you don't even have to go through the foreclosure process. They're just going to give the keys and they're going to give the house back to you. And then you now get this house that's probably worth more than $100,000 when you originally sold it. You know, the value of this house goes up over time. And that's another benefit too, is that really, let's say you fast forward 10 years down the road and this house has appreciated significantly more. I'm just going to make up a number here. Let's say the house is now worth $120,000 10 years from now. Okay, so that means that, and at that point you probably only have a loan balance of like maybe $80,000, maybe $70,000 on the house, right? So you could sell it again and actually make more money for the house by foreclosing on it than you would have made otherwise. So those are your protections there. And again, if you're interested in this, if you have more questions about it, about the legalities of it and everything, I can get you in touch with my real estate attorney, and they can explain everything to you. There's so many resources online as well, but I would encourage you to talk to an attorney about it. They're the best resource, obviously, because they practice law. But everything should be done through an attorney. We do everything through an attorney. All of our documents, our security deeds, we get title insurance on everything, promissory notes, everything is all drafted by an attorney. It's all done by the attorney to make sure that it's done according to Georgia law and it's done properly, and everything gets recorded at the courthouse in the respective county. So hope that helps. I'll do another video, another couple videos explaining a little bit deeper into this. But in a nutshell, this is how seller financing works. So hope that helps. Thanks for joining, guys.